Hi, today I have 8 more ideas how to be a successful investor. I have mentioned some points before, but I think it's very important. You cannot mention them often enough because the mistakes are always the same. So let's get started. First point you should really watch out is a moderate PE ratio. So stocks are valued on a price-earnings ratio. Like, for instance, let's say a company makes $1 earnings per share. So you can pay a PE ratio of 10 to 15. That means in this example, $1 a share means you can pay a price of $10 till $15. That's kind of solid and that's fair. Like in the boom of the internet, the hype years 1999 2000, we had PE ratios of 100, sometimes of 1000. People paid for AOL stocks 1000 times or 100 times earnings. That means technically, if you translate it, it means you have to wait 1000 years till it pays you back, till the company makes that money what you have paid for. Okay, moderate PE ratio. Another thing, your company should pay some dividends. It has not to be a huge payment. It has not to be a huge yield. That's not necessary, but I think you can find great stocks. If they pay dividends, it's a nice filter. That means they have money left over. They make free cash flow, and they give you some yield. They protect the stock from falling technically to zero, because yield is good and it's great, and there are great stocks that increase their dividend for 50 years or for 20 years, and that's what you should look for. The third thing, a great market share is a good tool to find great companies. They usually, if you have a market leader, they have nicer margins. And it's a signal that they have great products. Usually if you have a company that is market leader, that is a signal that should be great products. They have a higher margins and they are kind of usually protected. That's why they are market leaders, because they are probably better. Traditional, the fourth point is tradition. I think tradition is a good tool to filter. If you have a brand new company, a startup, a fresh, like Facebook has not that long tradition, it has a young management, you don't know if they are good the next 50 years, it could be, you never know, but there is a risk. So General Mills is around more than 100 years, ExxonMobil is around for more than 100 years, Walt Disney is very old, they have a tradition, Nike, many decades running, very successful. If you have a new portal, a new website like Groupon, Singer, they are new, there is a risk, and so you should be careful with newcomers and you should focus on traditional companies. It means less risk, what I said before. And then fifth, I think moral is important. Ethical behavior of management and the company. If a company is doing bad stuff to the society or to the people or to their clients or to their employees, that does not pay off long term, and you should know it. There are many negative examples. The banks, what they did during the financial crisis in the last 5-6 years ago, to rip off clients, to lie to them, or to cheat on clients, it does not pay off. The image is bad, and it's a very bad signal to you. Bad management, bad behavior, unethical employees. That's not good. It doesn't pay off. Northern Trust was a great company during the Great Recession in the 1930s. They did not participate in these bad stock scams. They did not participate. For them, the most important thing was to protect their clients' money, to protect the clients, to work for the clients, be honest, be fair. And so the other banks, people were panicking, running, taking out their money. on Wall Street. They went to the banks, there were huge lines, there was no more trust, but Northern Trust gained in the 1930s more than 10,000 new clients because they just trusted them and they knew the bank was there for them, and that trust is still around with Northern Trust. The stock didn't plummet like all the others. Compared to Bank of America, Citigroup, the stock is rock solid, and it pays off, to be fair. The chart is the sixth tool you should watch out. A great chart, a long-term chart. Look, just Colgate, for example, Colgate Palmolive is a great chart. It's amazing. Till if you go back, those companies like Exxon 100 years back, the charts, the stock charts look just fantastic. It tells you more than 1,000 words. If you have a great stock chart, it is just amazing, and it tells you something, that there is a good business behind, and they create value. Index, I think the index is important. You should watch out in the Dow Jones 30 or in the S&P 500. They are great companies. There's no need to pick up very small stocks. I think you should focus on blue chips. They have proven that they are great, and that's why they are in the S&P. That's why they are so large, because they are better than obviously the others. That's why they are larger. So you should watch in the what I said, in the large large index, and pick out of there a stock. And then it should, the eighth tip tool I have is, it should all sound logic to you. What they do, what they produce, what they offer. The whole service package should be logic. What they sell, like toothpaste or I don't know, paper tissues, creams, perfume, like oil, gasoline, energy. If it's complicated, like there are companies, they have complicated products or services, I think I would stay away. If you don't understand it, like Enron was very complicated to understand. No one really knew. The analysts didn't know what they do with their trading, and it blew up. Yeah, overall, to summarize, great PE ratio, not too much, dividends, logic, fair, moral, great management. And then you stick with those stocks, you keep them for 30, for 50 years. You reinvest the dividends, and you are very patient with them, and if the market drops, you maybe keep on buying, adding more to your positions. And if you do that, I mean, you will have a great portfolio. Okay, that's all for today. Bye.